everyone, this is Rob Roy and welcome to the Elliott Wave Options S&P 500 US market update. Well, the market did hit that 78.6% fib corrective level, but even if you haven't been to Pamplona, beware running with the bulls. Let's take a look. If you're new to the channel, don't forget to drop us a like and subscribe to be notified every time we upload a new update. At the time of this recording, it is midnight Eastern time on Monday evening, and the futures are currently down 5 points, so I'm not giving too much of a signal on Tuesday's open. Since the last recording, the market did hit that 78.6% fib level. That occurred on the 3rd of June, and then on the 4th, we had a doji, so it looked like, oh, we're at another fib resistance point. Maybe we pull back, but no, we just actually gapped to the upside and moved higher, putting some distance between the market and that 78.6% fib level. That means that according to Elliott Wave rules, we will go back and retest those highs. The question becomes, are we starting to get a bit overbought? In the intro, I said, careful with running with the bulls. And the reason that I say that is because signals are that we are just a little bit overbought at this point in time. Doesn't change the eventual target, just where we are currently. So you can see we have a gap there. There actually, believe it or not, is a little gap right there, and then we have this gap back here that occurred as we moved up to break above the 61.8% fib level. So notice that each time we broke above a significant fib level, we had a gap, again adding further significance, in my opinion, to the support resistance strength of those fib levels. So taking a look at the current strength of this move, if you're bullish, you can take heart in the fact that the DMI is showing that, hey, there's some pretty good strength to this move. The ADX is curling to the upside. It's about to break above 25 between the two directional indicators. That's a pretty good signal on the DMI. In addition, the Federal Reserve announced today, I tweeted this out. I don't know if you get the tweets or not. You can look at how to follow me on Twitter in the comment section of the video. But I tweeted out that the Federal Reserve is going to expand their new mainstream lending facility. Basically, they're going to lower the minimum needed to borrow and raise the maximum and move the time of repayment out from 4 to 5 years. Now that's designed to help small to medium businesses. It is a loan. It's not a pure injection of liquidity into the economy, but it's certainly designed to help liquidity issues for small to medium sized businesses that have been struggling, and any type of liquidity eventually works its way into the market. So all those things are positive as far as that continued move to the upside. The question is just, do we pause first before heading up there? I mentioned in the last recording about the rotation that was going on, and boy, has that continued since we talked last. Look at this vertical move to the upside in the XLI, the industrials, and looking at the Elliott Wave pattern here, there we are, right at that 78% fib level. Again, another signal of running into some resistance at that level, but we talked about that likelihood and that would disqualify any potential move to the downside from a 5-wave Elliott Wave pattern. So that looks to go up and retest the highs as well. Makes sense. And then looking at the XLF, again, continued vertical movement to the upside here. Looking at the Elliott Wave pattern, not quite as high of a corrective move as the XLI, but still the same type of thing, moving past the 61.8% fib level. Again, disqualifying this. But look at both of these with significant gaps. So the market is, at this point in time, just a bit overbought. We're going a little bit bull crazy here, if you will. So maybe a little bit of backing and filling is warranted at this point in time. I also promised to show you the financials. There has been movement there. The dollar has broken to the downside. We mentioned numerous times out of these patterns that the move would be significant when it occurred. And look at that move in the dollar, just basically boom to the downside. Pretty significant move lower there. Trying to find a bit of support here, but initially a move lower in the dollar is helpful to the market, adds support to that potential move up to retest the highs, if you will, because it helps the international companies with currency correction and everything else. So that's helpful. And then looking at the bond market, that's breaking out as well. The 10-year is a little bit behind where the dollar is, but it's breaking significantly as well. So a price movement to the downside in the bond means that we are going to get interest rates moving to the upside, and a little bit of that is helpful. So same type of thing here. A little bit of a move to the downside with the dollar is helpful. We just don't want it to move too far down to where it starts to show economic weakness on the horizon. Same thing with interest rates. Interest rates rising a little bit means that the economy is stabilizing, getting a little bit better, and that's helpful and supportive to the market as well, but not too much. You don't want interest rates to go too high. So kind of finding that sweet spot, if you will. And last but not least, before we wrap things up, I did want to take a look at the VIX. We've been talking about recently this little bit of a consolidation pattern here with this descending triangle pattern, and it looks like we're breaking to the downside. We may eventually be ready to come down and close this gap here on the VIX, also adding fuel to a potential move to the upside. So the bottom line here is the zigzag to the downside is disqualified. The move to the upside is the current pattern, and based on Elliott Wave rules, that has a higher percentage chance of even the zigzag initially. So hopefully you found that informative, catches you up to date. Hope everybody's well. Back to talk to you again soon. Take care, everybody. If you like these recordings, I'd like to invite you to join our new Trade Finder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.